In this video, I'm going to tell you the exact steps I would take if I was starting investing from scratch in 2026. I'm Johnny Mills, a chartered accountant, and I've been investing for 16 years. In a nutshell, investing is the only way you will achieve financial freedom. If you're not investing today, you will never be financially free. That said, if done wrong, investing can go very, very badly wrong. It can cause huge financial strain and can be an amazing way to destroy wealth. So you must do it correctly. So in this video, I'm going to teach you the 3S framework. Firstly, secure. This is the only way to invest without risking your personal financial stability. It's also the step that 99% of people overlook. Secondly, select. This is going to be choosing how much to invest, where to invest, and what to invest in. And these are going to determine your long-term success. Thirdly, set it and forget it. This is going to be where I show you how to avoid interfering with your investments and letting them do the hard work so you don't have to. So step 1, secure. So the first step to building an investment portfolio is actually not to invest at all. And I've seen so many people make this mistake. Remember, the goal is financial freedom, not financial stress. So you must be able to sleep easy at night knowing your finances are secure. And there are 3 ways that we do this. The first is by building what we call a sleep easy fund. You may also have heard this referred to as an emergency fund. The principle is the same. You must have 3 to 12 months of monthly expenses held in cash readily available to bail you out when something goes wrong, which it inevitably will. People get sick, people lose their jobs, people fall into financial difficulty. Having a sleep easy fund means that you know you have cash there and available to bail you out when things go wrong, which they inevitably will. Step 2 is all about having positive cash flow. That means spending less than you earn. What I see so often is people envy the trust fund babies or the people with rich parents. But what most people don't realize is what you put away every month into your investment portfolio has a far bigger weighting on your long-term wealth than where you're starting. The key is starting and being consistent. In order to do this, we must generate a big delta between what we're earning and what we're spending. That is ultimately going to drive your long-term wealth, not the position that you are in today. And the third step you need to take to secure your finances is installing data systems. When you lack data and you lack awareness, you'll make bad decisions, mostly emotionally driven decisions. And as a result, at best, your net worth growth will stall. You won't get to where you want to go, and you won't get there as quickly as you want to get there. And at worst, poor decisions can lead to bankruptcy. So data is critically important. There are 2 main sources of data that you need to have in place. The first is a net worth tracking system. You must know what you're worth at any given moment. This is your assets less your liabilities. Ultimately, your net worth is going to be your key metric for success in hitting financial freedom, in achieving your financial freedom number. The second is a cash flow system. Without a cash flow system, you have no control over the cash flows in your personal finances. When you do have a system, you have control, which means you can protect that monthly contribution to your investment portfolio, which, as I said, is going to be the biggest driver in your long-term wealth. So those are the 3 things we need to secure your finances. We need a sleep easy fund, we need positive cash flows, and we need data systems. So once you've secured your finances, then we move to step 2, select. And this is going to be all about choosing how much, where, and what to invest in. I'm often asked how much someone should invest on a monthly basis. And of course, the answer is unique to everyone. But what it comes down to is investing as much as you possibly can without putting your finances at risk. Stock markets have tended to produce reliable returns over long time horizons, over long periods of time. But in the short term, there are market fluctuations. If you overinvest, if you put your finances at risk, you could be left in a situation where you're forced to sell your investments at a depreciated price, so you could make a loss. You never want to be in this position. This is an amazing way to destroy wealth. So only invest what you can afford to lose, and make sure when you do invest, you don't undermine step 1, which was securing your finances. And once we've decided how much we want to invest, we now need to turn to where we're going to invest. And that is which investment account we want to use. And the first goal when choosing an account is always to make use of any tax-efficient vehicles that are available to you. The reason this is so important is because in most countries, you will pay tax on 1, capital gains, so any gains you make on share prices that you own, and 2, dividends, which are paid out to investors a bit like interest in a bank account in return for holding a particular share. So by using tax-efficient vehicles, we reduce or remove entirely the tax that are charged on your capital gains and your dividends. Let's take the UK as an example. There are 2 main options available to UK investors. The first is the ISA, an individual savings account. The second are pensions. Both of these accounts offer protection against capital gains and dividends taxes. Bear in mind when investing in a pension that, of course, that money won't become available until your retirement age. So if you do want to achieve financial freedom earlier than your retirement age, bear that in mind when making investment decisions. That's just taking the UK as an example. So depending on where you are, you must look into investment accounts and retirement accounts available to you in your jurisdiction. Then once you've decided the type of account that you want to open, you have to choose a company with which you'd like to open the account. There are lots of big names that you may have heard of, including Vanguard, Fidelity, Schwab in the US, AJ Bell in the UK. Typically, there are 3 considerations to make when choosing an investment platform. The first and most important are fees. Fees will eat into your investment returns over long periods of time, so you must be aware of what a company is going to charge in return for holding your investments for you. And we want to get that way below 1%, but ideally below 0.3% if you can. Then we turn our attention to the trustworthiness of the platform. You're going to be holding big sums of money in these investment accounts. So you want to have some trust that the company is well run and regulated. Thirdly, of course, user experience. Some people like to use browsers, other people like to use apps. Some are better than others. So read reviews of the particular investment account providers in order to make a decision over how flexible and useful the user experience will be for your purposes. So now we've chosen how much we want to invest, and we've chosen where we want to hold the investments. Now we have to choose the investments themselves. And the main goal when choosing investments is diversification. Everyone throws this term diversification around, but never really explains why it's so important. It's important because companies do fail. Take an example of an investment that I made into a food business in the UK. I put some money in, and within 3 years, the company had failed. I lost all of my money. The reason we diversify is because we recognize that companies do fail, like the example I've given. However, they tend not to fail all at once. So by diversifying, we give ourselves the potential upside of a company growing, of being a success, but we minimize the downside risk of one particular company failing in our portfolio. But then we face the question, how to diversify? Well, I could go and buy shares in hundreds of companies to build diversification myself. That comes with a number of downsides. It would be very expensive in terms of trading fees. It would be very difficult to manage and to do it properly. So thankfully, the finance industry has come up with products called investment funds that allow us to buy single products that give us exposure to hundreds of companies all at the same time. And there are all-world trackers we can buy that give us immediate exposure to global equities, but we can also build a portfolio of investment funds, investment trackers. So we can start to build a tailored portfolio giving us exposure to different companies, different sectors, different geographies in exactly the ratios we want to invest. So now we've secured our finances so we can sleep easy at night. We've selected how much we want to invest, where we want to hold those investments, and what we want to invest in. The third thing is to set it and forget it. What this means is automating our finances and our investment contributions as much as physically possible. The reason we need to do that is because it takes out emotion from your financial system. Rather than deciding when you might want to invest, trying to time the market, trying to guess when the best time to invest is, automating allows you to ignore all of the noise. You don't need to check the markets on a constant daily basis. You don't need to worry what Donald Trump is doing at any given moment. You automate your investments on a monthly basis and let things grow over time. And there's a huge amount of historical data which demonstrates if you take a diversified, long-term, consistent approach, it's unreasonable that you will not achieve financial freedom. And once you've automated your finances, your job is now to stay the course. This is easier said than done. If I take an example of the COVID pandemic, stock markets crashed by about 20% overnight. I have a friend who lost $1 million by selling at the bottom of the COVID crash. He thought it was going to fall further, but he timed it wrong. He sold at the bottom and then ended up having to buy back into the markets once they'd increased in price. So your job is to automate and stay the course. It will be deeply uncomfortable when market corrections or crashes happen. You will see the money that you've hard earned, you've put away, you've invested, decline in value, potentially in minutes. Your job is to trust the data, trust the process, and stay the course, because the data shows if you remain consistent over long periods, you will build wealth. Which is why my final tip to investment success is finding a hobby. 99% of investing is doing nothing. And there's lots of data to show that if you do fiddle, if you do try and intervene with your investments, you will tend to do worse than if you sit back and do nothing. So automate your investments. Don't agonize over day-to-day movements in the stock market, and go and find a hobby to keep yourself busy while your investments do the work for you. So now you know the 3S framework, let me tell you some mistakes to avoid at all costs. The first is trying to time the market. Trying to time the market is guesswork. You don't know whether markets are going up or going down, so don't even bother. The data shows if you invest consistently over time, you will grow your wealth. Second, investing in only one company. I made that mistake, so you don't have to. Use diversification to give yourself the upside of investment returns whilst minimizing the downside of companies failing. Third, buying assets that don't meet your investment goals and risk tolerance. Stock markets go up and down. In the long term, they tend to perform well and give you solid returns. But in the short term, don't put yourself into a risky position where you're forced to sell an investment because you need the cash at a particular time in the future. So investing next year's wedding fund, investing a house deposit that you intend to use within the next 5 years, any of those sorts of short to medium term financial goals, you must take that into account when choosing to invest in risky assets that will go up and down in future. Fourth, taking risk you're not comfortable with. Remember, the goal is freedom, not stress. Only take risks that feel comfortable to you and are not going to stop you from sleeping easy at night. Finally, acting emotionally. Emotions are a terrible state from which to make financial decisions. Set up your finances, get good data-driven systems in place, automate your investments, set them and forget them. So to summarize the 3S framework, secure your finances using a sleep easy fund, positive cash flows, and data systems. Select investments, how much you want to invest, where you want to hold those investments, and what you're actually going to invest in. Third, set it and forget it. Take emotion out of the equation, automate your finances as far as possible to take the thought and emotion out of it. And of course, avoid the 5 big mistakes that will destroy your wealth. And if you'd like one-to-one help installing the 3S framework we've talked through, use the link below to book a call with me and we'll see if it's a good fit. This is how I spend every single day of every year helping people get their finances off the ground and ultimately achieve financial freedom. So if you would like one-to-one help, click the link below and book a call with me.